The Treasury's hidden strategy: how property taxes become debt collection tools. 1. The public admission. In a live interview, the Treasury Secretary outlined the nation's debt policy in a single sentence: "We're going to grow the GDP faster than the debt grows." On the surface, this appears prudent. In substance, it is a declaration that government intends to inflate asset values, thereby expanding the taxable base. Rising asset values, especially property, become the state's collateral. Footnote: inflating GDP relative to debt translates into expanding the tax base, not reducing spending. 2. The mechanism of inflation. Inflation, portrayed as economic growth, lifts housing prices artificially. A home valued at $300,000 today may be assessed at $500,000 tomorrow. Although no new wealth is created, property owners face higher property taxes and inflated capital gains obligations upon sale. Paper wealth becomes taxable reality. Footnote: inflation disguises itself as growth, but its fiscal consequence is taxation on unrealized gains. 3. The assessment trap. As home values climb, municipalities reassess. Property taxes double or triple without any improvement to services. Failure to pay leads to tax liens, forced auctions, and dispossession. Purchasers of distressed property often include institutional investors with government ties. Footnote: tax reassessments weaponize rising asset values against owners unable to absorb higher carrying costs. 4. The forced sale squeeze. Increased property taxes coerce owners into selling. Every transfer generates multiple revenues: capital gains taxes, transfer taxes, and reassessed property taxes at the new inflated level. Each transaction is a triple win for the state. Footnote: the government extracts maximum value from every forced sale, before, during, and after transfer. 5. The banking backdoor. Inflated home values permit banks to extend larger loans. As mortgages expand, so too does interest revenue. This interest, flowing through financial institutions backed by government securities, indirectly finances the public debt. Home equity thus becomes securitized national collateral. Footnote: inflation allows private banks to expand lending, channeling interest into the government finance nexus. 6. Historical precedent. The 1970s serve as a warning. Home values doubled, but property taxes tripled. Mortgage rates soared to 18%. Families lost homes, not because values declined, but because carrying costs became unsustainable. Governments collected record taxes while households collapsed. The Weimar Republic and other hyperinflationary episodes show that inflated property values mean little when basic goods cost more than homes. Footnote: history demonstrates that inflated values often enrich the state while impoverishing the populace. 7. Scenarios of loss. Scenario 1: growth appears successful. Property values double, so do taxes and capital gains. Scenario 2: inflation dominates. Owners pay taxes on inflated assets while purchasing power erodes. Scenario 3: crisis. Values crash, but taxes remain tied to peak assessments, forcing foreclosures. Each path channels wealth from citizens to the state. Footnote: regardless of growth, inflation, or collapse, property becomes a consistent revenue stream for government. 8. Defensive strategies. Property owners retain limited remedies. 1. Challenge assessments. Success rates reach 60%. 2. Claim homestead exemptions to cap tax increases. And 3. Pivot into income-producing real estate. The latter converts inflationary forces from burden to advantage by letting tenants shoulder rising tax costs. Footnote: legal challenges and strategic property structuring mitigate but do not eliminate fiscal burdens. 9. Exploit and escape. The wealthy deploy a three-part response. First, hedge with gold and Bitcoin, insulating against currency debasement. Second, leverage fixed low-interest debt to hold appreciating assets while inflation erodes liabilities. Third, acquire income-generating real estate. Inflation that destroys savings simultaneously erases real debt when fixed obligations are repaid in devalued currency. Footnote: Inflation, properly managed, functions as an instrument of wealth transfer in both directions. 10. The binary choice. The Treasury's admission confirms the strategy: property wealth will stabilize public debt. Citizens face a binary outcome: serve as collateral for the national debt or invert the system by positioning themselves as beneficiaries of inflation. There is no neutral option. Footnote: In systems built on inflation, neutrality is impossible, one is either payer or profiteer.